Welcome to Phillip Mastermind. My name is Kim. Following a strong return of 7.67% last year, the ASEAN market has experienced weakness year to date, with the MSCI ASEAN Index falling by negative 2.72% as of 28 February 2025. Post-US election, inflation expectations shifted under President Trump 2.0, leading to increased volatility in FX and bond markets. ASEAN central banks became more cautious, though Indonesia surprisingly cut rates in January despite economic challenges. ASEAN markets underperformed amid rising US rates, a strong dollar, while earnings expectations were revised down due to heightened FX volatility. Year to date, Singapore's STI index was the only ASEAN gainer, both in local currency and USD terms, driven by strong domestic market confidence, value initiatives, the launch of the 5 billion MAS Equity Market Development Fund, and the robust banking sector earnings. Malaysia's KLCI saw a moderate decline, indicating relative stability. In contrast, the Philippines, Thailand, and Indonesia faced significant losses year to date, likely driven by weak investor sentiment and foreign selling. Specifically, in Indonesia, the launch of BP Danantara on February 24th had failed to positively impact Indonesia's capital market thus far, as investors remain skeptical due to concerns over the agency's leadership and governance. Investor sentiment was further dampened by MSCI downgrade of Indonesia from equal weight to underweight. Indonesia's JCI index also saw steeper decline in terms of the USD returns, reflecting significant currency depreciation. In Malaysia, the KLCI showed relative resilience compared to the broader market. However, the FBM Small Cap Index and the FBM 70 Index experienced double-digit declines year to date, reflecting significant pressure on small to mid-cap companies. Sharia-compliant stocks, as tracked by the FBM ERMAS Sharia Index, underperformed the FBM ERMAS Index, indicating weakness in sectors heavily represented by Sharia-compliant companies such as tech, industrial, and healthcare. The Malaysia market fell mainly because of the new US rules on AI technology and China's launch of DeepSeek. This has raised concerns about the global AI capbacks, with domestic data center related plays facing potential downsides in earnings. The shift in Fed rate expectation due to Trump tariff posture does not help. So, what's next? As of 28 February 2025, the MSCI ASEAN Index is trading at a PE of 12.8 times, 1.6 standard deviation below its 10-year average. We believe this is unjustified, as it almost approaching the low valuations seen during the COVID sell-off, which doesn't seem reasonable given the current situation. Consensus now projects the earnings growth of about 7.5% for MSCI ASEAN Index in 2025. The IMF projects the ASEAN 5 GDP to accelerate by 4.6% this year and 4.5% next year, building on the last year's robust 4.5% growth. This outpaces the global growth rate of 3.3% for both years, highlighting ASEAN's strong economic momentum and resilience in the face of global challenges. For Malaysia, the KLCI is currently trading at 13.8 times PE, one standard deviation below its 10-year mean. FBM ERMAS, which comprises the big, medium, and small cap companies in Malaysia, now trades at 13.4 times PE, 1.3 standard deviation below its 10-year mean, and we deem this as attractive. Furthermore, consensus now projects earnings growth of about 8% for KLCI and FBM ERMAS in 2025. The IMF projects Malaysia's economy to grow by 4.7% this year and 4.4% next year, building on a solid 5% growth last year. We see several factors supporting the potential for higher valuation multiples, including sustained strength in domestic investments, both DDI and FDI, ongoing fiscal consolidation, especially subsidy rationalization, and the strengthening of the ringgit. While we expect elevated volatility in the short term due to uncertainties surrounding the Trump administration and policies, Malaysia, like other markets, experienced a broad decline. There are pockets of opportunity to invest in sustainable dividend-paying stocks and undervalued names that have been overly derated after the recent sell-off. Given the current macro environment, we remain positive on domestically driven sectors and direct beneficiaries of NETR, such as construction, property, and utilities. We are also optimistic about financials, supported by growing confidence in Malaysia's structural reforms and their sustainable dividend yields. Key risks include potential setbacks in Malaysia's macroeconomic recovery and corporate earnings growth, driven by slower global economic growth and increased geopolitical tension. Both the ASEAN and Malaysia markets are supported by strong dividend yields, with the Bloomberg consensus projecting a forward dividend yield of 5.4% for MSCI ASEAN and 4.7% for the KLCI. These figures are comparable to levels seen during the COVID pandemic. In times of uncertainty, these markets can act as a safe haven, offering both stability and attractive returns to investors seeking protection from more volatile assets. To conclude, as markets grapple with heightened uncertainty, we emphasize the importance of diversification and a focus on quality amid volatility. A noteworthy avenue for investors seeking diversification in their portfolio is through PhillipCapital Malaysia. PhillipCapital Malaysia offers multiple prime managed account services managed by professional fund managers. By leveraging PhillipCapital Malaysia's prime managed services, investors can enhance their resiliency, optimize portfolio performance, and navigate the complexities of the market with confidence. Apart from our inaugural prime managed account services, we also offer unit trust funds and P3W8 that could cater to different investors' needs. That's all for today. Stay tuned for our next Phillip Mastermind. This update is brought to you by PhillipCapital, your partner in finance.